So let's just begin with the big thematic bid that we've seen through tech through 2017 and the relative softness that we've seen over the last couple of days. Walk me through what you're seeing.
I think there's a little bit of a reinvigoration of some of the Trump trades that we saw after the presidential election last year. So back then, bond yields rose. The market got a little bit more excited about stronger growth and rate hikes. Bond yields rose, financials did well, and tech got left behind. So I think there's a little bit of that going on, revisiting some of the growth and Trump trades of the end of last year.
Is there a chance that this becomes quite self-fulfilling, that people get nervous and it kind of gets more selling and then that kind of begets more selling? Is there a risk that that happens here, Rob?
Yeah, these things can become, as you say, self-fulfilling. I point out to you that Tobias Lefkovich, our US equity strategist, is currently overweight financials and underweight tech. So to him, this switch makes sense.
So, Robert, the question I think all of us are asking ourselves is this just sort of a short-term, limited sort of retrenchment on something that was overstretched, or is there something more fundamental going on here? I mean, and I don't want to draw connections where there aren't any, but we just had something close to Bloomberg that we had Viking return $8 billion of their fund. 7 of their top 10 holdings, according to their last 13F, were tech. So this is really having some pain in the marketplace.
Yeah, right. I mean, I always think that the best sayings for stock markets are the old sayings, and there are these old sayings that bull markets narrow and bear markets broaden. Well, this bull market had been narrowing, as everyone knows, into these relatively limited large cap tech names. So a bit of an unwind of that narrowing, I think, makes a lot of sense. You know, it doesn't mean that the trend is over completely, but it may have got overextended in the short term.